Hey value investors, thank you for joining me. Today we're going to talk about the free stock shop. I'm going to talk about 3 areas to help you go from being a novice investor or someone that's been kind of investing for a while to get into the mindset of being a professional investor. If you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. What's more, you can do a review online and check. Just type in Deep Value Returns into Google and see the reviews that people do to see if that helps you figure out if it's worthwhile for you. And you can do a totally free trial. Also, don't forget to subscribe to this channel so you can get my next value installment. So we're going to go for 3 different areas to help you think like a professional investor. Number 1 is keeping your emotions in check. Number 2, the stock doesn't know you own it. Number 3, holding periods. Okay, so keeping your emotions in check. So the first thing that's worthwhile discussing is that all the work that comes into buying a stock is done before the person buys a stock, okay? So this involves you figuring out the competitive landscape, having a little think about what his peers are doing. Okay, so if all the peers are doing really badly and this one is like also doing badly, it's possible that the whole sector is going to be struggling. It is possible to, through deep value investing, to pick out the leader in that sector, the strongest company in that sector, and to make an investment and outperform the market by buying these deep value stocks. This is something that I've got a lot of practice on, and there are a few different things you have to think about. Now, for example, let's say that you're buying a sector that's out of favor and there's not a lot of growth in that sector. That's a difficult investment, because if you want to be doing, let's say, a 15% performance annualized, buying into a sector that's falling, for example, retail, that's kind of like getting demolished by online competitors, it's a very difficult game. You can get something that's cheap and it ends up getting a lot cheaper. So by positioning yourself and doing all the work beforehand, that helps you get confident and to keep your emotions in check as the stock becomes volatile over your holding period. So go through the 10K, look at the risks, get familiar. You just need to know the top 2-3 risks. Really try to understand, okay, this is how the company is doing. Go through those earning calls. At the very minimum, you need to read the past 4 earning calls, at the very, very minimum. It's not a lot of work that you need to do, but you do need to be quite familiar with that. And look at the peers. Try to get a grasp how the peers are doing. But ultimately, I say this in all my videos, you don't know anything about the company until you bought the first share of the company. Once you bought that first share, you're a shareholder. You are an owner of that business. You go from being a user of that product, you can be a tech developer for that product or whatever. You go from being on the side to being in the driving seat. And that nothing can teach you that. I spend a lot of time following different companies, but until you really get to grips with being the owner of that business and thinking about the business model, that's really what's going to drive your future return. I tell this to everyone. What drives the share price higher is the perception of earnings power 5 years out. Even if I don't have a position in retail stocks, but even if you're going into retail stocks, and you have to really try to figure, don't hope for mean reversion, because some sectors do get disrupted and they don't come back. Mean disruption kind of gets a lot of headlines in value investing, but in reality it's very, very difficult to do. If you're only going to have, let's say, what I think is a reasonable portfolio, let's say 10, 12, 15 positions, mean reversion is a difficult game. It can work on certain instances, but those tests that a lot of people do, screen tests, they're looking at large number of stocks over large periods of time. That is something that works very well in theory, doesn't work so well in practice. I don't want to drop any names, but if you've been in the game for a little while, you might be familiar with what I'm saying. The way to do it is really to try to understand, think like a business owner, follow what Warren Buffett and Charlie Munger do. It's not about having tons and tons and tons of stocks. It's about understanding the dynamics, the total addressable market, thinking about the landscape, thinking about the competitors, thinking about the valuation. If you have that large margin of safety in place, it doesn't matter too much about the volatility in the interim period. Point number 2 is that the stock doesn't know you own it. And this is something that sounds very easy on the surface, but this is something that really comes through practice. I see a lot of investors get really caught up in the story that the CEO spins out to investors. They kind of know all those kind of ins and outs. And if you've read Margin Safety by Seth Klarman, he talks about the Pareto rule, but this is a famous rule of the 20-80 rule. So you get to know 80% of the information in 20% of the time. You're not going to know every single thing about a company unless you work at that company. And even then, it is possible that, let's say you're like a top manager in the company, or even CFO, or even the CEO of the company, you're not going to understand everything because the future is unknowable. So a person spends so much time digging in and finding out little nuances, and they're missing the whole dynamic. Okay, so what's more important as well is that this leads you to confirmation bias. So a person spends so much time researching the stock, researching the company, and what's actually happening is that they're getting more and more entrenched into their own ideas. They're looking for confirmation all the time of why they are right. So you're not actually getting an information edge, you're just getting a confirmation edge. And what the problem with that is, let me tell you about a little bit about loss aversion. So when it comes to loss aversion, if I say to you, let's say I'm going to give you $1,000, you wouldn't be that bothered about it. You kind of like, okay, cool, that's cool, yeah, nothing more. But if I said to you, okay, I'm going to go in your wallet and I'm going to take $1,000 from you, that kind of gets your pupils dilated, that'll get your adrenaline pumping, and as an investor, making a gain is not that meaningful to you as an investor, but making a loss is really painful. So when I talk about the stock doesn't know you own it, it means that if you buy the stock and it falls back and it falls down, and you kind of, I'm going to just kind of wait until I get back to break even. The stock doesn't know what your break even point is. So what's very important is not to price anchor and to try to figure out what the value of the business is. So this goes to point number 3, the length of time. Okay, I see 2 very different dynamics in investors. I see some that are just in and out of the stock within a couple of weeks, and I see some that are really long-term holders, and they kind of own this stock for 4 or 5 years, and the stock has gone nowhere. So you gotta, in your mind, I always tell this to everybody, write down, before you do the work, before everything else, before you buy the first stock, write down 3 points of why you think the company should be worth more. And have a consideration about your holding period, because the length of time dictates your return. If you do, let's say, a double and it takes 10 years, that's not very, you might as well just cut the index because you would have doubled in 8 years. So have a think about the length of time that you own it. But ultimately, what I think is quite important is to understand. Let's say you own a stock and you bought it, and 90 days later, just for example, earnings come out and it totally devalues your original written down thesis. So you'd written down the company is doing X, Y, Z, blah, blah, growth rates, etc., etc. Earnings come out, they lost a key contract. The company was making, let's say, 20-25% from that one customer, they lost that contract. That could throw away the thesis. So your ability to take that information on board and say, okay, yes, I've only owned it for 90 days, but when I wrote down X, Y, Z, this is what I was thinking. I was thinking I'm going to hold it for 3 or 4 years, assuming it was going to grow at, let's say, 2, 3, 4, 5%, or, might need to grow at a higher rate to justify the valuation. That's a different story. But you have a thinking, you have an analysis in your mind, okay, this is what the stock needs to grow at. This is what the company, let me rephrase, sorry. This is what the company needs to be growing its revenues at to justify this valuation. So the ability to say, okay, this is a thesis breaking moment, and to be able to step back from that moment, because the ability to take action when it's required, but at the same time being incredibly patient, is what leads investors to strong returns. This is something I talk about in my marketplace a lot of the time, and it's quite difficult for a person to be incredibly patient and at the same time incredibly decisive when something unfolds in a certain way. So you're looking for something that either makes the thesis or breaks the thesis. Most of the time, a company is going to tick along, share price is going to oscillate a lot, but most of the time the company just ticks along. The narrative changes and unfolds over time, but there's not a lot of surprises. But when something does surprise you and it breaks your thesis, you have to be willing to act at that moment, because you don't know over the next 2 months, 3 months, as analysts start to kind of go from being overly bullish to overly bearish, and it comes report in the media after report in the media, and everyone's jumping on the bandwagon, even after you felt, okay, maybe this is not really working out the way I felt, and the stock just keeps on falling. Now, this is not to say that you should sell necessarily into bad news. So let's say bad news comes out, but it doesn't break your thesis, that does not mean you need to sell. So there's a subtle difference there. Something that breaks your original thesis versus something that is just bad news. You don't want to necessarily sell into bad news. So as a value investor, you have to train your mind. Your mindset comes in over practice, over time. So you have to be able to understand if something breaks your thesis or just a bit of bad news. You don't want to sell into bad news. The stock is down, let's say, 5%, 10%, or even more. You don't want to sell into the bad news, but if something changes fundamentally in the thesis, that's quite important, and you need to be willing to act at that moment in time. So we talked about 3 different areas here. We talked about you as an investor keeping your emotions in check. We talked about the stock not knowing that you own it. And we talked about the length of time that you as an investor should be thinking about. So when you go out after watching this video and you think, okay, I'm going to try and adapt those strategies that Michael was talking about, think about just writing down things before you make the action. Say, I'm going to hold this stock for 2 or 3 years, and try to be quite strict with that. But that doesn't mean that if kind of your thesis breaks, you have to stay there for 2 or 3 years. So it's quite nice to have a piece of paper, because the piece of paper is not a judge of you, and if things change, you have to be willing to step away from it. So if you found this video useful, come over to the marketplace on Seeking Alpha. It's called Deep Value Returns. You can do a totally free trial, and you can find out the stocks that I own and see if that resonates with you. I do something called a hybrid portfolio. Hybrid portfolio is I have value stocks. These are more mature companies, low growth, low valuation, and I have something that I'm going at a faster speed, but you have to pay a higher premium. So I hope you found this video useful, and I'll see you next time.